Are you following the Buy Refurb Refinance strategy? Good. Or is it bad? Watch this video as I give you the yin and the yang for this strategy. Hi everyone, my name is Simon Misiewicz from Optimise Accountants and welcome to today's session. We are going to be talking about the Buy Refurb Refinance strategy. And why is it that people wish to do that? Well, there are three main reasons we're going to be focusing on. The first one is you might want to pull out all of your money, because if you are buying a property, redoing it up to a higher standard and then getting a refinance on it, you might be able to pull all of your money and then it gives you an infinite amount of return on your investment because you've not put any money in. The second thing is you might wish to reinvest the money that you've pulled out. So you might want to buy a property, but you don't have enough money to keep buying more properties. So buying one property, doing it up, and then getting the money out enables you to utilize that extra money you've pulled out of that first deal into the second deal, into the third deal, into the fourth, etc., etc., etc. Get the point? I hope so. And then finally, you can increase the return on investment, as I mentioned earlier. Now, as we go through this, how does it really work? Well, the first stage is you buy a property. Ideally, you buy it below market value because when you come to refinance, you've already got that surplus equity built into the property without doing anything at all. So looking at below market value properties would be ideal for this particular strategy. You would add value to it, so refurbishment. You might buy properties that are run down, uninhabitable. So therefore, when you're doing things to the property, you're making it look good again in a lettable condition for you then to get higher amounts of rent and more mortgage. What you're aiming to do here is increase the end value for which the bank will then give you money. The idea behind it is that you would wait 6 months, do all the work to it, go back to the same bank or indeed a different bank and then say, look, here's a property, can you refinance it for me based on the new valuation? And finally, you would then invest, ideally. Now, the reason why I say ideally, because I want to go through an example later on of people that use this strategy, but not in the right way. They will pull money out of the property and then go out on lavish holidays, nice sports car, nice watch, you know, the same old people, right? That will do all that kind of stuff. Really, they are doodads. Robert Kiyosaki said it himself. Make sure that you reinvest your money into property or other types of investments rather than buy doodads because they do not bring in the money, let's be fair. So ultimately, you can carry on through that process of buying one property, refinance it, get your money out, buy the second, buy the third, buy the fourth property, as I mentioned earlier. Now, we're talking about Buy Refurb Refinance, but we've talked about this on my online community. I'm live every Wednesday at 7 p.m. to take your tax questions. And the Buy Refurb Refinance strategy is one that's always been an interest to the audience. So I'm on there live. So why don't you trial us for 7 days? There's a link below this video of the online community. You can ask me questions for free this Wednesday. So why not hook up for your 7-day free trial? Now let's talk about how it works from a refurb refinance. Now on purchase, you'll have a property. I'm just going to get my highlighted now. So just to make sure this works, laser printer, there we are. There's your property value of £200,000. Initially, you get a mortgage of 75%, maybe £150,000. What you'll end up doing is getting your refurb done at £50,000. I don't know if you might make a loft extension, tidy up the kitchen, the bathroom, etc., etc. And then the end value, if you're lucky, by the way, this is below market value. That's why the gap is so large here. You bought the property below market value. You did some value added stuff here. And then the end value now is £350,000. Which, by the way, when you're getting a 75% mortgage, you're increasing the value of the mortgage from £150,000 all the way now to £262,500. This is a magic number. Why? I'm glad you asked. Because of this, really. You'll notice that the new mortgage is now £262,500. The old mortgage is £150,000. So the extra money you're pulling out is £112,500. Why is that so interesting? Well, the original amount that you deposited for this house was £50,000. You spent another £50,000 on the refurb, meaning that you had invested £100,000 of your own money. But by using the Buy Refurb Refinance strategy, you was able to pull out £112,500. And this is called no money down deal. Now, I use this phrase as people say no money down. And the reason for that is because you might loan this money from parents or from friends. The same again for the £50,000 there. So it could be a no money down if you say to them, I'll pay you back in 6 months' time. Whatever the outcome, you've now got no money invested in this property at all, and yet it's giving you the rental income from that property. Now, if you want to talk about tax structures of how to set up properties so you can then go through the Buy Refurb Refinance strategy, why not book time to talk about our services? Equally, you might want to talk to us about our tax services for a one-off consultation. I've put both links of those services below this video, but make sure that you use the code YouTube24. YouTube24? I was thinking about the TV series 24. I have no idea where that's come from. But if you use the code YouTube25, then you will get a 25% discount. So what are the downsides to the Buy Refurb Refinance strategy? Well, the first downside is mortgage interest relief, section 24. You will know by now that you are not allowed to offset the mortgage interest cost against your property income to get tax relief. Ultimately, you now only get a 20% tax reducer on the mortgage interest cost, which means you'll end up paying more tax. The other side to it is that you'll have more mortgage interest costs, which means you have less profits, less cash. If you pay more tax and have less cash, that can be a real detriment to your property business. Mortgage interest cover is also weakened. Now, the banks will stipulate to you that they want a certain amount of coverage, whether it's 125% or 145% of mortgage interest costs. Now, if you're not having that because you've got a weakened position on your properties, then you may struggle. And more debt equals less liquidity, which again is not a good place to be in sometimes. If the property prices come down and the mortgage is so high, then you may not be able to even pay the mortgages off. So you could find yourself in a moment of bankruptcy if you're not careful. Now, I've talked about section 24, and if you want more details about that, then please do watch that video that's appearing above my head right now. And there's a link about section 24 mortgage interest relief cap also below this video. So do check out that video if you want more details. Now, what I want to talk about is BRR and S24. So Buy Refurb Refinance and section 24. I did it an acronym because I simply ran out of space. So, more tax. Why does it lead to more tax? Well, it's more tax and less profits, really. So here's the old mortgage, and we talked about doing the refurb refinance strategy to get a new mortgage in place. Now, if we've got a mortgage in the old rate of £150,000, we are looking at a 4% interest rate. So we're not going to be exploring any different rates here. But the interest per month on that mortgage would be £500. Now, that interest per month will increase to £875 because the mortgage is now £262,500. Now, for most of you thinking, well, it's a great idea to be able to pull the money out of the out of the property. So, I can boast that I've got no money left in the property. That's great, but let's have a look at what impact that can cause you. So the first instance I would say is that before the BRR and after the BRR, the income, the rental income from those property is the same, £800. Why would it be any different? But now we've got the interest costs of £500 in the old mortgage, but £875 in the new mortgage. All of a sudden, now we've got a profit of £300 BRR. before the Buy Refurb Refinance strategy took place. And now we've got a £75 loss, which we still got no money left in the deal. But now you're in a position whereby you are losing money to give to the banks. Well, what's the point? You might have pulled money out, but if you're now giving money back to the banks and you have nothing left, then eventually that's going to cause you a major headache. Does that sad story end? No, it doesn't. Unfortunately, no, it doesn't. What we need to now look at is the tax position. Now, we know that Section 24, Mortgage Interest Relief Cap, ignores mortgage interest when calculating tax. So we've got £800 worth of rental income, as we explored before. But now we've got, as a high rate taxpayer, this is, of course, you'll have £320 worth of tax, but you get a 20% tax relief on the mortgage interest cost. Now you'll notice that says £100, which is £100 of 500. Sorry, 20% of 500 to give you that £100 tax relief. The net tax is therefore £220, leaving you with an income after tax of £580. This is before and ignoring the mortgage interest cost for this example right now. And the after BRR has taken place, income is still at £800, tax at £320, adding back a greater amount of mortgage interest relief, 20%, because you've got a greater amount of mortgage interest. But still, you've got a tax bill to pay. And if you remember in the previous slide, we said you made a loss. So get this, you have got a loss, but you're still paying tax. Let's look at this. So before BRR, after BRR, this is the only two comparisons. You had a profit, a real profit of £300, really. Now here you had 875, you had income of £800, mortgage interest cost of 875, leaving a loss of 75. Now tax here, you've got £300 worth of profit, but you've got to take off £220 worth of tax, leaving you with £80 worth of profit. Cash profit, this is. Now here, you've got 87 loss already, but now we've got to take off a further £145 worth of tax, leading to a huge and significant loss in terms of your cash flow of £220 per month. Now, that basically means is that you've got this property, and because of BRR, Buy Refurb Refinance, all you are doing is paying money to the mortgage lender and paying money to the taxman, and you have nothing left. Now, I appreciate some people will be saying, but what if I reinvest into another property? Yes, I get that. But now you've still got to cover the loss on this property by £220. And it's not always that easy to do. So do always do your due diligence to make sure that you can indeed reinvest this money and make a good return on that investment. Now, we do have a tax calculator to show you ways of minimizing CGT and looking at the ways of extracting money out of a limited company. I will give you those links below this video, so go and check those out for $9.95. And don't forget to like this video, or indeed subscribe to this channel to make sure you don't miss out on any future videos. And finally, if you've got any questions at all, make sure you add your questions to the comments box below this video so I can answer them as soon as I can. My name is Simon Misiewicz from Optimise Accountants. I'll see you again soon. Thank you.